And the CEO of Potash holding a conference call with reporters right now and saying to assume BHP is the only game in town is incorrect. Of course, Potash saying it's been talking to a couple of other players. For more on how this all affects stocks sentiment, let's check in with strategist Craig Peckham of Jefferies. He joins us now live from his trading floor in Manhattan. Craig, good of you to join us. And it feels like this is stage 2 of this M&A story. The first was deals are announced. Now it's, okay, in one case, there are clearly multiple bidders, and in another, there could be more bidders to come. Is that a bullish sign for stocks?
You know, John, ordinarily it would be. This is the type of behavior that the market generally likes. Competitive bids, hostile bids, taking that on top of what's more broadly a general increase in friendly merger activity. People refer to it sort of animal spirits in the marketplace, and this is a good example of that, with corporates obviously looking to deploy these record amounts of cash that have built up on balance sheets through the downturn during the cycle here. I would say that the reason why it's not a unanimously positive indicator here is because at the same time this is happening, and last week we saw a cluster of deals announced, we also were unfortunately on the receiving end of some disappointing macroeconomic news. We had a jobless claim number which breached the 500,000 level again, and the Philly Fed number was really quite poor here. So it's become a bit of an overused cliche here, but I think this looks like a kind of a classic tug of war between what's happening in corporate boardrooms and what's happening in the macro data stream.
Craig, very quickly before we go to break, we were talking to Michael Pond about the outlook for bonds, the bonds versus stock story. Is it really a bonds versus stock story, or is it a stock valuation versus bond story? Yeah,
I think you're on the right track with respect to valuations here. They've obviously contracted a bit. At the margin, what that is telling you at some level is that some risk that the market sees to where estimates stand for next year. Do remember, though, that part of what's happening in the Treasury market is certainly a risk aversion trade. And when you look at the bond market, I think it's an oversimplification to simply look at the low Treasury yields. You do need to look at how spreads have compressed across credit-sensitive products there. That tells you that that credit risk investors are actually feeling a little bit more positive than necessarily the Treasury market tells you in the absolute sense.